Now back to Money Talk on News Talk 580 CFRA.
Well, I'm joined using Skype today with my friend Dean LeBaron, who's the founder of Battery March Financial Management and a true adventure capitalist. How are you, Dean?
Very fine. Thank you, John.
You had your swim this morning?
I have had my swim this morning, and I'm going to try to have one this afternoon. Mid-year New Year's resolution is to do twice as much exercise as I did yesterday and earlier, but we'll see how long that lasts.
For our listeners, you and I are vintage characters, and we're watching the last act for us of this economic play that is going on. Now, I'm going to hand the podium over to you, and you can vent on whatever is on your mind.
I hate to say it, say like Donald Trump. I'm not going to look at this teleprompters on each side of me. And I'll pull some notes out from my pocket, and I won't even look at those, but let me make the message. Please pay attention. Something is going on in the world now, and I sense very much that these old boys, Bill Gross, George Soros, others, have a sense that something's going on, but they haven't the faintest idea what. And they know it's not going to be what went on just in the past. Today, for example, at 1 o'clock Eastern time, an important meeting of Apple Computer goes on, and that's supposed to be a major announcement. I don't know that it will be. I don't know that it is, but I do know that something is cooking. We have had now for the last couple of years, the markets, stock market and bond market, disassociating themselves from the economy. When I started business with you, John, way back 50 years ago, we used to look at forecasting as if they were forecasting the business of the companies that they represented. So if General Motors stock price went up, he said, I know they're going to sell more Chevrolets next month than they did this month. No, that's not true. Now, increasingly, the covariance of the stocks is separate from the economy. One case, it's a casino. In the other case, it's just sort of a no-growth environment around the world. The old smart guys, I think, like Bill Gross, say, it's just different. Relax, we'll find out what it's like in time. There's some other smart boys who say, I'm so smart, I can tell what's going on in this, and I'll apply my old tools. All I'm saying to everybody, to all of our listeners, pay attention. Something's cooking. I'm in the group that says, I don't know what it is, so I'm going to pay attention.
Well, if something's cooking and these very clever people who have lots of experience don't know which way the market's going to go, and keeping in mind that there's very little volatility right now, this is sort of the still before the storm or the exuberance, how do you position yourself?
There's several ways of positioning yourself. One, you and I are fans of hard assets, meaning gold, specifically physical gold rather than paper gold, is one way of doing that has worked well in the past. There's another way is to listen to some of the new economies that are coming along. The G20 meeting just concluded in China, where the president of China lectured the president of America, very much for the first time. And for as far as I know, for the first time, America did not lecture the Chinese about human rights. And that, believe it or not, is very indicative because the Chinese do not like to be lectured about human rights. I've been in meetings with Chinese since 1982, something like that. And all meetings would start with 20 minutes on why did you blow the head off your uncle with an anti-aircraft gun or something like that. And the Chinese did not want to be lectured on those things. That's the way they ran their country of 1.3 billion people, and that's the way they were going to. Now, they're running it their way without putting up with lectures. The lectures are running the other way. They're lecturing us on fiscal prudence. Let's get ready to be lectured to by Chinese, perhaps. So what do we do? Is I think you do it as little as possible. If you want to be diversified and have a few equities, do so in India that you've talked about, which is perfectly fine. Probably that's more interesting than, and maybe even have some in China. But even in India, China, and the rest of the world, there's a phenomenon going on, and that is that the world's capital flows are getting stickier and stickier. The last 50 to 70 years, capital flows were easy. People moved around easily from border to cross border. Money moved across border. Now it's getting a little bit tougher. And you and I will chuckle a little bit at this because we hear something we haven't heard of before in capital flows, and that is it may well be that they will have some new rules, but they will be applied retroactively. And in the world of law, we're supposed to apply rules proactively in advance so that people can adjust for that. But we haven't heard that expression, retroactive rules. I'm paying attention to that, and I've heard it a couple of times, and it troubles me a little bit, and it will trouble me more if I continue to hear it. But I suggest to our listeners, they worry about the word retroactive, and things can happen.
And in the past 10 days, we've heard that the European Union is presenting Apple with a bill for $14 billion of back taxes, and that's in effect a retroactive tax because Apple had negotiated with Ireland, and this is new information to them.
That is correct. And in the case, Ireland says they don't want it. So who's speaking for whom? I mean, as you know, I'm a lazy guy. I'm trying to spend more time, as I say, swimming in the pool or sitting under a palm tree in Florida, where my intellectual activity is to count the number of coconuts that fall from the tree just over my head. When I get up to about a dozen, I quit counting. But that's my intellectual activity. Something's going on, and it's going to be of a major form, whether we have Bretton Woods again or not, whether something happened at Jackson Hole or not. I do notice, for example, that gold went up 2% yesterday. I don't care about gold movement from one day to another, but 2% on any kind of a movement in this kind of a no growth market is worth paying attention to. So I'll pay attention to it for a while.
Now, last week I talked with my old friend John Embry, who has been in the game 50 years, as we have, and he talked about so many asset classes being overpriced. Real estate is at extreme prices, bonds are extreme prices, and stocks have been beneficiary of low interest rates because dividends have been very attractive. So there are very few asset classes that represent really good value.
That is true. I'm a bottom fisher. I try to restrain myself, however, and John is a little more forward-looking than I. I'm trying to be very suspicious about my ability to say something is overpriced or underpriced. It may well be that in the new market, the market for the millennials, and the market of the next 50 years, the market that our mutual friend, Professor Nikolai Kondratiev, tells us about, is the next wave. The next time that Professor Kondratiev comes to see both of us, he may well tell us that we have entered the new season and forget about what was overpriced or underpriced in relationship to our former knowledge, and there's going to be a new metric. There was another good friend of mine, a former colleague, who's well known for regression to the mean and picking out every bubble and so forth. But he's been having trouble recently, and he's been getting very, very angry with the market. He's getting angry with the market, and he's angry with his colleague because it's not behaving the way it's supposed to. So he is expressing his anger in some uncomfortable ways. I'm trying not to be like that kind of old codger who's so sure that I know the history that I will say such and such a thing is overpriced and such a thing is underpriced. We may move to a new metric when there's a variety of other things that will determine price, and I'm trying to be open-minded to that. I must admit, thus far I have failed. I mean, I'm as hidebound as everybody else, but I'm working at it.
And it never hurts to have a little cash on the sidelines.
We are accustomed to making our investment decisions in terms of risk and return. And we've learned that, and we have fancy algorithms that do it these days in a millisecond. But there's another third dimension that's cropping up now that is increasingly more important, and that's liquidity. And it's not only cash, but it's cash that you put your hands on and walk around with. I withdrew some money from a bank recently, a little bit more than you'd get out of an ATM, but it wasn't an outrageous amount. And they said, oh, yes, Mr. LeBaron, we'll be happy to have that for you. And if you come back in 2 weeks, we'll have this cash here ready for you. Well, goodness gracious, I was quite accustomed to walking in and they'd recognize me immediately and they'd hand me money if that's what I wanted. This is now not the case. I've had a Swiss friend with me this weekend, And he was reminding me that in Swiss banks these days, they are behaving differently. Even keeping money in a safety deposit box is a little different. In the bank that is charging negative interest rates just to hold money, if you hold cash in your safety deposit box in the bank, you are essentially holding money for a competitor to the bank in terms of it running its administration, because the cash is a competitor to the bank's form of collecting money from its accounts. So you have to be very careful. I'm attempting to be broad-minded, and I'm working at it. We're going to have new metrics for what's overpriced and underpriced, but I may be wrong.
Well, it's always a pleasure, Dean, to get your snapshot of what's going on in this world. And thank you so much for joining us. And we'll talk again soon. And have fun.
Au revoir.
Well, that's it for Money Talk. Just a few end-of-show comments. We'll see whether the Federal Reserve Board governors will continue to augur an imminent rise in interest rates. This stock market decline may have shaken them up a bit. Now, I receive a comment from John Murphy, who's a well-known technician, and I'll just give you the points that he made. He said a jump in global bond yields sent bond and stock prices sharply lower on Friday. Long-term charts continue to suggest a bottom in the 10-year Treasury yield and a bond market top. S&P 500 falls below 50-day moving average in heavy trading. The volatility index jumps 40% to a 2-month high. And the fact that we've entered a seasonally dangerous autumn period also calls for more caution. I hope that you have a good week, and we'll be back next Sunday, 2 p.m. I'm John Budden, and you are listening to 580 CFRA.